Welcome to The Explainer. Today, we are cracking open the case file on one of the most intense processes in all of finance, the multi-million-dollar investigation a private equity firm launches before they even think about buying a company. So let's put you in their shoes for a second. You're about to spend, let's say, $100 million on one decision, one company. The pressure is on. I mean, how do you even start to wrap your head around that? Where do you begin? Well, the answer has a formal-sounding name, due diligence. But don't let that fool you. This isn't just ticking boxes on a form. Think of it more like a full-blown corporate investigation that can take months, all to answer one simple question. Is this company really what it seems? And just like any good detective story, you can't just go in blindly. The whole investigation is built on 4 core pillars. These 4 critical lines of inquiry that together paint the full picture.
So what are they? First, you follow the money. That's financial. Then you size up the battlefield. That's commercial. You look under the hood with operational. And you check for hidden traps with legal. Let's start with the numbers.
All right, first up, financial due diligence. This is where the team basically interrogates the numbers. They're poring over every financial statement, every tax record, every cash flow pattern. They're not just taking the company's word for it, they're rebuilding the entire financial model from scratch to see if the story adds up. And the absolute holy grail of this process is something called quality of earnings. See, what they're trying to figure out is what are the company's real, sustainable profits. They have to separate the steady, repeatable income from some one-off lucky break. Because, you're buying the company for its future, not just one good quarter. Okay, once they've confirmed the money is real, the investigation zooms out. This is commercial due diligence, and it's all about sizing up the battlefield the company plays on. How big is the market? Is it growing? Who are the other sharks in the water? And maybe most importantly, do customers actually like this company? Really, all of that work, all those questions, they all boil down to this. Does this company have a real competitive advantage, something that makes them special? And is that advantage actually built to last, or could it disappear tomorrow?
So, the third line of inquiry is operational due diligence. This is where the private equity firm basically pops the hood on the business to see how the engine is running. They're looking at everything, how the supply chain works, how effective the sales team is, and they're always searching for ways to tune it up and make it run better.
And all those findings lead directly to what's called the value creation plan. This isn't just some vague wish list. No, this is a detailed, step-by-step blueprint for exactly what they're going to change, improve, and build after they buy the company to make it more profitable and more valuable. And finally, we have the last pillar, legal due diligence. And let me tell you, this one is absolutely non-negotiable. This is the search for skeletons in the closet. Lawyers go through every single contract, check on all the patents and trademarks, and look for any pending lawsuits that could turn into a nightmare down the road. The goal here is simple, but it is so crucial. Protect the investment. You have to mitigate all those hidden legal risks to make sure you're getting a clean title to the business. No surprises, no hidden liabilities waiting to jump out after the check is cleared. Now, you might be wondering, who on earth does all this work? A private equity firm can't be experts in everything. And you're right, for an investigation this massive, you have to call in the specialists. So they assemble this expert team. They bring in big accounting firms to handle that super detailed financial dive, especially that quality of earnings analysis. Then they hire strategy consulting firms to tackle the commercial and operational puzzles. And, of course, they have specialized law firms whose only job is to hunt down and neutralize legal risks. So after months of work, after all these experts have turned over every stone and scrutinized every detail, it's finally time for the verdict. Everything comes together to make that one final massive decision. And in the end, it really all goes one of 2 ways. On one path, the investigation uncovers red flags, deal breakers that are just too risky, and the firm has to walk away. But on the other path, if everything checks out, they build their investment thesis. That's the final, rock-solid, evidence-based argument for why this is a winning deal. It's an incredibly thorough process, right? It's all about data, about quantifying risk, about leaving nothing to chance. But it makes you wonder, after all the numbers have been crunched and all the contracts reviewed, what about the one thing that you can't really measure on a spreadsheet? The people, the culture, the passion. How much does that matter?